Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. And we are going to continue with our little mini series on the 7 stages of private equity. What could be more exciting? With today's episode, it's called Exit, Sell, Return on Investment. This is episode 15. And TGIF, it's Friday the 13th. That's right. So happy Friday the 13th to everybody watching. You guys are awesome. As always, a shout out goes out to my YouTube channel members. You guys are awesome. Right there. Join my channel. Membership has its privileges. And also to my Patreons, to my super thanks donors, and to you, my participants, viewers. You guys are awesome. Thank you for being here. This is the live stream that I do once a week where we talk about private equity and all things kind of high-level business, all wrapped into one mélange, as you call it, for those of us that are more cultured, or a bunch for those of us that are less cultured. But that's okay, because we're tripping over our words because it's Friday, and that's fine. As long as we haven't died, then we're doing fine. Okay, so I was actually going to devote one episode to this stage of the private equity process. I actually did do a little bit of preparation today, and I found that there's just no way I could talk about this step in one episode. There's too much. There's too much to go through, so I'm going to break it up, and I'll probably do a part 2 next week or something. So let's dive in. We have covered the private equity process. If you don't know, private equity is when a company buys a company. That's what it is. Okay. Private equity firms are companies, and they're in the business of buying other companies, but they do it in a particular way. The old name for private equity used to be leverage buyout, LBO. And that's because, as the name implied, leverage, they do it mostly using debt. So they borrow money to buy companies. That's what it is. And the idea is you're essentially going to be flipping the company in kind of the same way you would flip a house. You buy it, you fix it up, and then you sell it for more than you bought it for. That's the idea. Okay. So that's what private equity is. And it's a very, very common, popular thing. And that's why we're talking about it. We have covered in the last several episodes the process of doing this. And it's a 7-step process. So first you get target identification, right? That's where the private equity firm is looking for a company to buy. So we call the company they're buying the target firm as opposed to the private equity firm, right? So target identification. Then we do due diligence. That we did an episode on that. Valuation. We did an episode on that. Negotiation. That was another episode. Acquisition, that's where the transaction actually takes place. We did an episode on that. And then you get the part that I find by far the most interesting, post-acquisition improvements. I'm not a big fan of flipping things. I'm a fan of actually improving things properly. And so that's where we talked about post-acquisition improvements. That was last episode. And today we're talking about the final and 7th step in the process, which is where you essentially sell it. You've bought it, you fixed it up, and now you're going to sell it. Okay. So let's dive in. Now, just a brief recap. Last time we were talking about, as I said, the part that is the most interesting to me by far as a management type, and that is the post-acquisition improvement. So what you can do with the business when you buy it, okay? And a lot of that is to do with improving it, genuinely improving it. Some things you do are kind of short-term, cosmetic. Other things are much deeper, long-term type things. That's what I'm mostly interested in because it ties together with, what the essentials of being in business are all about, like how you can make money, how you can add value. Okay, so just a very, very brief recap of last time. We talked about 6 ways that you can improve the business, okay, once you have it. If you recall from last episode, we talked about operational efficiency, okay? You're doing stuff to the business to actually make it operate better, usually in terms of operations. Cost management, just taking a look at your costs, making sure that there isn't any wastage or you're paying more for things that you don't need to. Management and talent. This is the easiest to do. You get more capable people with sounder decision making in place, and they can do a better job, all things being equal. Revenue growth. Okay, so just trying to sell more and paying attention to your marketing side of things as opposed to your operation side. Culture and communication. This was one of the more exotic things you can play with, but you can make serious improvements there. This is all to do with the employees, basically. And technology integration was the last time. So was the last one. So once again, a bit more of an exotic thing there. You can make little changes, that are quick and easy to do, but when it comes to major technological upgrades and things, you're going to upgrade your ERP system or whatever. That's very complex. Takes a lot of time, a lot of money, a lot of effort. That's why it's one of the more exotic things. But anyway, we talked about those last week. So now that we've done all this, okay, and we've improved the business, private equity firms also like to do other things. They like to leverage the business right up with debt. It improves some elements of the financials in some ways, makes it more attractive, but they're ready to sell. So that sets the stage for what we're doing now. And hello from ISA Trap and to NDA Crash Course from India. Thank you for joining us today. Okay, let's dive in. Now we're ready to sell. So what do you do when you sell a business? Well, there's obviously several things you've got to do. You're going to do several things. And I've sort of divided this into several steps. It would really be better if I had some visuals. I'm going to have to try and get some slides or something for next time. That might be an idea. Anyway, okay, so basically what I'm going to walk you through is this. We're going to talk about preparations for the sale. We're going to talk about how to identify buyers. Okay, we're going to talk about how do you market the business. Okay, so how do you make it attractive and get people that are interested. Negotiation, okay, what is involved in that, and closing the deal. And we were going to talk about ROI. Now, I'm not going to have a chance to do those last three items, but let's just jump in. So, preparations for the sale. What do private equity firms do at the last minute to try and make the firm more attractive, the target firm more attractive to buyers? They do a couple of things that I would call lipstick and mascara. They're not really improving anything anymore. They're just sort of making it look nice. They're making it shiny. Right? So there's kind of two categories of this. One is improving the financials, okay, and the other one is improving the operations. What do they do for the financials? Well, there's certain accounting treatments that are, I don't want to say standardized, but common, and they can make the business look artificially a little more attractive. Now, I'm not an accountant, but I've seen this stuff done. And for example, they'll make adjustments to the financial statements that sort of boost certain ratios and things like this, make it look more attractive. Make adjustments to make the earnings appear higher. That's one thing they do. Okay. For example, deferring a lot of expenses. Okay, so that's a trick that I've seen that people use, where you normally have periodic expenses, like monthly expenses, and right at that time, just to make things look even better, they'll defer a lot of expenses right then. And if you have an accountant look over your statements, they can detect this kind of thing. But it's not obviously apparent, unless you're going to get an accountant to really go through everything very in depth. Then it's not something you would immediately notice, okay? The other thing they'll do is they'll improve their operations. So, for example, if you want to arrange a tour of the business, that's something that some people do in these situations. Other buyers don't feel a need to really go down and check it out in person. necessarily, but if you're going to do that, you'll do certain cosmetic things. You'll spruce up the place, make sure it's tour ready, make everything look clean and bright and tidy, that kind of stuff. And that includes training the employees on the tour. So briefing the workforce and the people there, including the management, to give nice answers and things like this, and not do anything that would be off-putting, right? So there is that element where they make it look attractive from the outside. Okay, so that's one of the things that they do in these circumstances when they're preparing the business for sale. Let's talk about identifying buyers. Okay, who would buy a business that a private equity firm is selling? So if the private equity firm is selling one of their target firms, that I refer to as a target firm, but it's their asset businesses. There's basically, to my knowledge, there's three sort of categories of buyers for this kind of thing. Okay, so you've got other companies, you've got private equity firms, and then you've got like institutional investors, right? So let's talk about this. So other companies, who would buy a business? Well, the obvious thing would be the competitors, right? The business's competitors. Maybe they want to buy up their competitor and absorb them and take them out of the running, essentially, so that it furthers their purposes. That's a very common thing to do. You want to eliminate competition? Great. You want to expand? You can do this all in one shot, right? So competitors are the number one. Suppliers. This is also somewhat common, where you're going up and down the value chain. So you would have somebody upstream or downstream of you want to buy you, and then you get more of a vertical integration type of thing. Now, vertical integration has its proponents and its detractors. My understanding is that according to the latest economic theories, it only really works if it's like, end to end, or something like that. Like if you just integrate, two levels together, but you have a bunch of downstream stuff and a bunch of upstream stuff still, it doesn't pay off, really. That's kind of my understanding. But then again, I'm a bit old school on this, so I don't know if they've revised their thinking on that. But that is something we see sometimes. Sometimes if there's some special reason to do it, other than simply it's part of your supply chain or it's part of your value chain, you know what I mean? Like you have a similar approach, you use similar technology, similar skills, things like this. That's when it might make sense, and you might actually get some synergy out of it. My thing jumped on me. How did that happen? Where was I here? Okay. So anyway, that's my understanding of the vertical integration thing. It's a nice theory that people had once upon a time. It's been sort of done in practice to varying results, but it comes with a whole bunch of caveats. So anyway, but that is a thing where you might want to market the business, right, to upstream and downstream companies. Conglomerates, once again, technically you could sell this to conglomerates. I didn't think conglomerates really, really existed widespread since the 70s. This was kind of a theory in the 70s that's kind of fallen from favor. What they were trying to do was diversify. You know how you would diversify your money by buying securities and investing in many different types of companies all over the world and stuff. This was a sort of like real version of that, where you'd have one company. Like I remember companies like Yamaha, they were like really big in the 80s, and they would make anything from motorcycles to jewelry to prophylactics to, they would just make everything, right? Because they had so many different divisions and units under in their group of companies or group of business units, but it was all run as one company. And this kind of fell from favor because they thought they would get advantages with diversification, but it didn't. And instead, they just, there's no synergy, basically. Everybody knows what synergy is. Hopefully, that's where, two companies, they're each worth a certain amount, right? And the idea is that if you bring them, this one's worth $5 million, this one's worth $5 million, the idea is that if you combine them, they wouldn't be worth 10 million. They'd be worth more than 10 million, like 15 million if they were combined. But if you had them as separate entities that are uncoordinated and unintegrated, they would only be worth 5 each, right? So that was the idea of synergy. And my understanding was conglomerates they failed the test in theory and then they failed it in practice. But we still see some companies that are described as conglomerates today. You still got some big ones out there, things like Sony and stuff, GE, Anyway, but they are a target class of buyer for private equity target firms. Okay, if these companies are looking to enter new markets or they're looking to diversify their portfolio of companies, these would be potential buyers. Okay, you can also get tech companies, right? People that are wanting to buy the target firm more for its technology or its IP, its intellectual property. You see this, right? It's not that they're necessarily in that business, but because they're interested in the technology that target firm has pioneered or developed. Okay, so that's one category. That's like other companies, right? Who would buy a private equity target? Other companies, right? These are the other companies that could be interested. So you'd want to check those out. Another class of buyer for a private equity target firm is another private equity firm. And this is kind of a little bit less intuitive, but there's this whole ecosystem of different types of private equity company that all specialize in different things. They specialize in different scales. They specialize in different holding periods. They specialize in terms of different appetites for risk. Some private equity firms only buy very conservative, low risk businesses. Others, they are less sensitive to the risk. They'll buy more risky type things, right? So you get like one private equity firm, maybe a smaller private equity firm, buying a target that's maybe risky. It's kind of new. It's kind of out there. Maybe their sales or their revenue has been very volatile over the last several years. And you'll get a small private equity firm perhaps buy it, fix it up, get it a bit more stable, improve its reputation in that industry. And then when they sell it, they could sell it to a different class of private equity firm, one that's larger, one that is perhaps not really wanting to get into very high risk type areas, but they're only interested in sort of more conservative type assets. Now this target firm has been fixed up. They've had more experienced management and all this kind of thing. So now that firm becomes a more desirable target for an upscale private equity firm. So I believe the term is going up the chain, for that kind of stuff. So you have a larger private equity firm might have the resources to take the next step also and scale up that business. So if a smaller private equity firm has taken it from like, I don't know, $1 million annual revenue to like $10 million or something, or $5 million, something like that, you might sell it to a higher class of private equity firm that's going to take it from $5 million a year to $50 million a year or something, that's a thing that does happen. Private equity firms can also specialize in different sectors, different industries. So, you might buy the firm in one industry, have it open a new market, have it get into a different type of business, right? And then when you sell it, now you could sell it to a private equity firm that specializes in that second business, right? So that's another opportunity there too. Something else, I don't know what the term for it. The only term I've heard is something like platform plan. That's where a company wants to buy a thing, okay, a private equity target firm or asset, and they want to use it as a platform, not to take the company in its existing form, but to turn it into a group of companies that do various things with that asset. Okay, so you don't want to turn it into a larger company. You want to turn it into a group of companies that all sort of feed off one underlying business, right? That's the idea. So, yeah, I mean, I don't know much about this firsthand. I've never seen this personally. I've heard about it, but I haven't seen this. So, I mean, I don't know. When you think about this, it reminds me of almost what they did with Hollywood, where they would buy intellectual properties and, try to turn it into like a platform. You'd make all kinds of movies, all kinds of series, theme parks, merchandise, all these different things, right? That kind of thing. So you buy the initial property and then you turn it into a group of businesses, right? That's the idea. I haven't seen that in heavy industry, put it that way, but that doesn't mean anything. And there could also be an arbitrage opportunity why you'd want to sell it to a larger private equity firm, because you bought this thing for maybe a small amount of money. You're going to sell it for a higher amount of money. Maybe it's trendy now. Maybe there's a buzz around that particular thing. Maybe you're spinning it a different way. Maybe you're slightly changing the direction on it. So, you could sell it for a greatly inflated price now in this climate of opinion, So there might be something around that. Okay, so those are all the reasons and all the forms that you might want to sell the firm to another private equity company. Okay, that's another class of buyer. Finally, what did I say before? I goofed up my words before. The third, I don't know what I said. I think I said institutional investors. What I meant was IPOs, initial public offerings. This is another way you could sell the business. You could just do an IPO. Okay, this is where you sell the shares to institutional investors or even the public on some kind of stock exchange. So that's the idea. I mean, people do this. I've never had any involvement in that myself. My understanding is the theory is that I just don't get IPOs personally. I mean, it's a known thing that they sell for a very inflated price on their first day, and then it sort of rebounds and goes right down, and it eventually reflects more of what one would think the true value is. But despite knowing this, and despite always seeing this pattern, people still do this. People still go nuts on the first day, and I just never understood that. If you know that the first day it's going to spike and then it's going to come back down, usually on day 2, I don't understand why people are all buying on day 1. That's just my thing. But whatever. Hello to Omar. Omar says, "Hey from Saudi." Hello, Omar. Thank you for joining me. Okay, so we covered the stage where you're identifying buyers for the target firm. Okay, we covered 3 classes of buyers: other companies, private equity firms, and an IPO. Now we're going to talk about marketing the business. Okay, so this is an aspect of selling it. You want to market it. How is this usually done? There's a couple of things I'm going to cover here. Preparing the marketing materials and approaching buyers. So let's talk about that. Preparing marketing materials. There's usually one sort of master document. Okay, it's almost like a prospectus. Really, it's kind of like a version of the prospectus. It goes through the whole shebang and bang, and it's called, at least the term I've heard, I think this is an American term, confidential information memorandum. Okay, I've heard that called different things. I mean, I'm in Canada, so I don't know if it's based on each country has a different term for it or what. I don't know, but the sort of industry standard thing, as far as I know, is called the CIM, Confidential Information Memorandum. This is the master document. It's very thick. It's like 50 to 100 pages, maybe more, depending on what we're talking about. Probably more, definitely for bigger companies. And you have to sign an NDA to get a look at it. Because it gives all the, it gives the name of the company, it gives all the inner workings, all the financials, all that kind of stuff. So that's usually the sort of master thing that you use when you're marketing the business. Okay, in addition to that, you're going to have many other documents. You're going to have little teaser documents where almost like a pamphlet, you can kind of hand it out because people obviously are not signing an NDA to see a pamphlet or a 1 or 2 page thing. It doesn't list the name of the company and it doesn't list any confidential information. So that's kind of the deal. But it's basically a summary. It says like, look, are you interested in a business in this industry? This is the specific thing that they're doing, like, the generalized, like this is the edge that they have or what the approach they're taking, how they're positioned for the future without giving away personally identifying information. These are some of the basic financials, sort of like a hook, but without disclosing what the company is. And this is usually blasted out initially to gauge interest. Okay, so you've got these little documents going everywhere just to see if people are going to be talking about it or expressing any interest in it. There's many more marketing materials, including things like personal presentations that are done like in person or over video link. There's all kinds of, obviously you'd have the financials and you'd have all kinds of other documents. So, but that's basically the summary. You've got the master document, the CIM, and then you've got a bunch of teaser stuff where, there's NDA stuff and non-NDA stuff. Okay, so armed with that, then you can approach buyers. Let's talk about approaching buyers. There's a lot under this category. Let's talk about the different types of buyers that there could be for this. So a common thing is search funds. That's called different things in different countries, but basically private funds that someone has set up and they're looking for assets to put in that fund, right? So they've gotten a bunch of money, they've gotten money from investors, and they've pooled it together and they're looking for something to invest in. So you've got those type of search funds. They're searching for something for assets. You've got family offices, like, the funds that manage the wealth of high net worth individuals. So you've got, you've got billionaires, you've got, like deca millionaires, things like this, all kind of pooled. And these funds are looking for investments. So you can go to them, right? You've got institutional investors, things like pension funds, things like, university endowments, right? Where they pool their money and they invest it in various things. Insurance companies, they kind of just invest all their money that they have in various things. So, you've got these sort of targets. They're very common for buying private equity firms once they've been sort of cleaned up a bit. You have meetings with people. You can also do bids. Okay, like bids are done different ways. You have auctions, and you get these people together. You could do broad auctions with like 50 to 100 buyers, that kind of size. You have more limited auctions, maybe 5 to 20 buyers. That kind of stuff, where you pre-qualify the buyers and all this kind of thing. Most private equity firms work with investment banks, merchant banks, or M&A advisors, this kind of thing. So, there is that connection. That's a big thing in the US. I know. I've never dealt with that personally, but in Canada we have that, but it's a little bit less structured the way it is in the US. It's not quite as prominent, but it still takes place. Okay, so that's pretty much what I'll say here about approaching buyers. So we covered preparing for a sale, we covered identifying buyers, and then we covered marketing the business. Now, I was going to try and do this whole thing in one episode, but we're already at like half an hour, so I'm gonna wrap this up a little. But next time, I want to do a part 2. We're going to cover negotiation and closing the deal, and then we're going to talk about ROI, return on investment, in these types of situations. So I will open it up for questions. If there are any questions, speak now or forever hold your peace. But this is a huge industry. private equity is a huge, absolutely huge. And, I've traditionally had sort of mixed feelings about it. It's really cool in some ways. It's a bit of a leech in others. You've got basically money from the people, basically, whether it's from personal finances, from, them sort of giving it to large firms that then invest it back in smaller firms. It's like basically taking the money from the low level and then pumping it back up here to sort of build the business, right? Now, it's fundamentally a good thing. It's just that I have mixed feelings about financial services. I don't know if anyone shares those. There's a lot of silliness and inefficiency that goes on in that process. You get a lot of finance type people. And I know what I'm talking about. I believe I can say this. I mean, I've got a master's degree in finance. I can say this. That don't really understand anything operationally about businesses. They don't understand anything economically about the businesses or anything to do with the businesses themselves. But yet they're all involved in the process and they're skimming quite a bit off the top. It should serve, in my opinion. So anyway, that's just what I think about it. So this is where we really get into that kind of stuff. So next time we're going to talk about the final steps of this process, negotiating the deal and then closing the deal. And I wanted to give some basics on ROI. It's funny, when I was teaching stuff similar to this in business school, to sort of like the first year kind of people, there was, just talking about ROI in itself. Everybody talks about ROI in the sense that you're selling the asset, right? You buy a stock or something or a bond, you pay a certain amount for it, it makes a certain dividend, and then its value, grows or shrinks over time. And then you sell it, right? So you've got the starting price, you got the ending price, you've got like any, distributions or anything, and then you calculate return on investment, right? Like, was it worth your investment? This is a case where, a lot of times you're not selling it, or you're selling it years down the road, right? So you're looking at ROI from the perspective of, you're not selling this business. The business is in your charge and it's making money, So it's a slightly different ROI calculation. And I wanted to talk about that too next time. So that's what we'll do. Okay, thank you for being here. There's 7 people here. You guys are awesome. I will be back next week, same time, with another edition of Private Equity Rundown. And remember, it's Friday the 13th, so go out and conduct yourselves accordingly. Take care.